Like I said, we are recording this, so one thing I always say at the beginning of all of these webinars is when you guys get this in your email or you guys receive this, watch it again, especially if this is a strategy or something that you're not really familiar with. If you watch it right away, it's something that is going to make it stick in your brain. If you go back and think, I got this strategy, I've got it figured out, but then 2 or 3 weeks down the road, you go back and look at this, and it will really make it sink in, and you guys will remember it for a lot longer. You will learn it, whereas when you go through it the first time, it's almost like just trying to memorize it real quick. You're going to lose that. It goes into your short-term memory. If you watch it again, it goes into your long-term memory, and it will stick. That's right, Kathy. It sticks in more the second time. Because a lot of this stuff will kind of blow by you. You're thinking about different questions you're going to ask, and when you ask those questions, had those answered, when it goes through again, you will remember it all. And this particular webinar is going to be on trading correlated underlyings to help increase your gains. Now, just about everybody out there has a core portfolio somewhere. And this particular strategy is going to be looking at adding something to that core portfolio. So it's not necessarily something where we're going to be buying a stock, but we are going to be approaching this with the mindset that it is something that we would be comfortable adding to a core portfolio. And as an options trader, even I have a core portfolio, and I trade around that, sell calls against it, covered calls, and try and lower my basis. So this is going to be something where we're looking at different stocks that are at extreme perceived value. And when I say perceived value, it's your perception, just like we were going back and forth with Kathy and I before this. Everybody has a different idea as to what value of some stock is. Kathy bought the dip in Apple yesterday, and I had been long some, I had been long some puts in Apple. So I had a different idea as to thinking Apple was going to come down. Kathy made the right decision and scooped some up. So, but this is to say that this is something that I would want to add into my core portfolio. I don't know if Kathy added those or is going to add those Apple to her core portfolio, but this is going to be with that mindset. Anyway, having said that, my name is Eric Wilkinson. Some of you guys may recognize me from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from geopolitical to economic and market analysis. I've been trading my own money for well over 20 years now. I'm not here to tell you that I'm going to make you rich or that I'm going to make you a millionaire, but I am here to help teach you to take control of your finances, manage your own portfolio, and most importantly, manage your own risk. I've gone back and forth with several people lately. If you have your money in Vanguard or something like that, that's a buy and hold strategy. And if you did that at the beginning of the year, as of yesterday, today it's rallied back, but you could look at it for all intents and purposes, your portfolio is unchanged for the entire year, especially after they pulled out all their fees that go into all those. So you just aren't going to be able to make money. And as much as I know about efficient market theory and Eugene Fama and all of that, those guys came up with a lot of those theories before there were options. And there is an opportunity out there to lower basis, which ultimately increases your profitability. There's just no ways around it. And when you're trading options, it's a great way to leverage your money and increase your profits more than if you were just always buying stocks and holding them. So I've traded in most markets throughout my career. From the Chicago Board of Trade, I've traded everything from stocks, financial futures, commodity futures, currencies, equity futures, and options on all of those products and in all market conditions. I've seen just about everything and been on the floor when those things were happening. And a little disclaimer I have to go over is, any opinions, news, research, and analysis or other information provided here by ProTrader Strategies, associate companies, or employees is not necessarily to constitute investment advice or solicitation to buy or sell any of the security strategies, da 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 da. The reason why we can't do that is because I don't know each and every one of your guys' risk parameters, and everybody's risk parameters are different, and they constantly change. The other thing is I don't know what's in your portfolios, so some of the strategies or some of the underlyings that I would be talking about implementing might not be appropriate for your portfolio. It might overweight you in a certain sector, or really go outside your comfort. So that in and of itself is why we can't really give out, hey, this is a great stock, this is where you should implement something. Okay, so take what we teach you guys in this, play around with them a little bit, and then implement them into your portfolios in your own way and with your risk parameters in mind. At the end of the day, we just tell you to do your own homework, and please remember, past performance of any trading system or methodology is not necessarily indicative of future results. Now that I got all that SEC stuff out of the way. All right, so we're going to be talking about laddered puts and correlated underlyings. Now, I've done a webinar on laddered puts before, and this is just a way to kind of put a little twist on it and take a couple of really correlated underlyings and ladder those puts at the same time. The reason why a certain sector might be down, is just it's falling out of favor. It's a cyclical cycle where things, these big money managers are rotating out of one sector and into another, and it really pushes some stocks below levels where they really should be. And like I said, this is for when you're very serious about adding something to a core portfolio, because we're going to be pretty aggressive with some of these strike prices that we're picking, and we're going to be collecting the premium, knowing that we're going to probably get tested on it, and if it gets put to us, we're going to be okay with having that. So it's kind of like, you're doing this strategy around a dollar cost averaging to lower your overall basis, which is going to ultimately increase your alpha on those particular underlyings. Now, I don't go into this strategy every time thinking, yeah, this is something I want to implement into my portfolio, but this is a strategy where I think something is really oversold. There's some value there. I can collect a little premium, and if I pick it up, then I'm going to take that into my core portfolio, and that's going to be where I start selling calls against it, like I mentioned earlier, and I'm going to try and lower my basis on that even further. So think of it that way. That's what a laddering put type of strategy is you are doing a little dollar cost averaging. I get ribbed sometimes about this strategy because just laddering puts, for that matter, because people are like, what, I don't want to pick bottoms. I don't want to, try and find the low of a stock. Well, if you're going to add something to your core portfolio anyway, you got to pick a time and a place to buy that stock. It's not just throwing darts at the wall as far as I'm concerned. I like to try and find things that are oversold and take advantage of that then. There's always an opportunity for that. So at the end of the day, you got to pull the trigger to buy some stocks to add to your core portfolio. This is a great way to implement that type of strategy of dollar cost averaging and putting stocks into your portfolio if that's what you're comfortable with. So like most of my other strategies that I talk about, we're going to be taking advantage of volatility crush or volatility collapse. On the floor, we used to call it the crush, when volatility really comes out of these different option strategies. As the market sells off or stocks really get pushed down, there's usually volatility pumped into those premiums, because on the downside of any market move, people will have a tendency to buy puts and sell calls, which skews that towards the put side. So when there's panic in the market, usually the puts have a lot more premium in them than their counterparty on the call side. So we're going to try and take advantage of that too and get some volatility collapse when things start to normalize. And we're right now at the perfect time to implement some of these strategies, because the January contract has like 42 days left in it, and that is really where we're going to start seeing this volatility contraction. If you watched any of my webinars, I almost always pull this little graph up, because I think it's a great way to look at what happens, excuse me, what happens to your premiums. The further duration out, you know, they don't decay quite as quickly, but then when you get inside this 45 days to like 7 days, you get 50% of that theta decay happening. So that's what we're trying to really take advantage of. Get inside of this 40 days and then just watch this theta come out of these, because when you're selling premium or selling options, you are collecting premium and you just want to see those premiums come out quickly. So when you buy it back, you're buying it back to for very little. All right, so sorry about that. All right, so like I said, this is going to be a bullish strategy. So this is going to be a stock that we think is going to go up, or we want to add it to our core portfolio where we're long the stock then, and we are going to want this to go up. You can do this with put spread, but you just aren't going to collect a lot of money for those spreads. So I usually do this with just naked puts, which is what I did today in one of the with one of these correlated underlyings. And we have a bell, sorry, so I got a little ahead of myself. So like I said, we're going to be doing high implied volatility, 35 days to expiration, 35 to 45 days to expiration, high implied volatility of plus 50%. We're going to be looking for correlation of 70% or better. And I'm going to show you guys a particular website that you can find this out a little bit quicker. And we're going to be using the 35, and I say ish delta. That's where we're going to be starting to sell our front month premium. And then after that, I'll go into where you find your next strike in the further duration expiring months. And we're going to be trying to do this at an extreme price. Well, what is an extreme price? It's going to be your perceived extreme price. And you have to be willing to have the underlying put to you if you're doing this as a naked strategy. So have that in mind going into this. So I did lose some of my, so this is what I was talking about with the 35-ish delta. We have a bell curve here, and I've shown this several times. We're going to be looking at 35 delta, which is right in here inside of one standard deviation. And this is the best example I could find of skew in that bell curve. So when the puts get pushed or start getting bought up, the premiums start getting pumped up. So you start getting this skew to the put side. So this is the inside the normal bell curve, and then this is the negative skew where the calls are getting bought up. And you more times than not are always going to have this skew for the put side. It's the best one I could find for you guys to show how the different ones get kind of moved. And so having said that, let's move on to the platform. This was the way that I used to always do it, and I would pull up a chart and start finding stocks that I thought were correlated. For instance, this is Adobe on the purple, and then we have Microsoft, which is, or sorry, Microsoft is the purple and Adobe is the multicolored. So you could do something like throw in Cisco here and you know, do an eyeball as to the correlation there. You can see this is a pretty correlated stock, despite the fact that it has moved dramatically there. That is a pretty correlated stock for all intents and purposes. Now, this chart is done by pulling up the comparison line. So if you just go over here and type in comparison, and you can pull it up. You can also change that line. Just go down here to the secondary security, and I can change it to just about anything. So I could do like, let's just say for the oil, because the oil's been in the headlines and on top of everybody's mind with OPEC saying they're not going to stop production, and it just sent oil in a frenzy today. So we could do that. Okay, so oil not You know, you could almost say oil's correlated to Cisco. Uh, so oil, so some oil stocks. What do I have in there? USO. So we could do. Let's do. Oops. Chevron, and you can see that this is pretty correlated. They are going to go lockstep. You know, as oil goes down, these oil companies aren't going to make as much money. So you can look at rig. Rig is another one where they have been lockstep almost to the dime. Now, I don't know if I really want to play around with rig with this, but just because I have some oil stocks in there, but you know, this would be an easy one to look at on a relationship side because they're both around the same pricing for the most part. I mean, they're a couple dollars off, but they are pretty close that way. The other one, XOP, we could look at, which is the ETF. You know, those should be very correlated. But I don't want it to be 100% correlated either because you know, you're going to lose on both ends if they're like 100% correlation. I like to have a little bit of wiggle room there. Like if one starts rallying, it will help me out on the one that's not necessarily working out. So I don't want both of these to be losers. So I like to play this, like I said, with a correlation of 70% or better, but it's usually about 70 to 95 or something like that. I just really don't want it to go to 100%, which is a rare occurrence anyway, but somewhere between 70 and 90-ish would be a good one to have correlation on. You can also switch, like I said, you can switch this up and make it just about anything. I could make it Under Armour and add that, make it Under Armour, and then you could start looking at some of the other retailers like Lulu. See that those guys are pretty correlated, despite the fact that they've separated out here. You can tell with the charts on the ups happened, on the downs happen, and kind of eyeball it that way, which is in the past what I've normally done. But I have a little hack for you guys that you guys can take advantage of that I just pretty much found. Where is it? Which is this website here, macroaccess.com, and I can basically build out this matrix by playing around with these different. You can close out these. Now it's a free website for the most part. You know, after maybe 5 tries at doing this matrix, they're going to lock you out for the day. But you know, if you write them down, which ones you think are going to be correlated, then you can put them in here. Now, I didn't think all of these were going to be correlated necessarily, but I thought there was going to be a couple of them that could have some correlation, so I threw them in there up there. So as you can see, like Mosaic is pretty highly correlated to potash, and if you're not familiar with those two companies, Mosaic and Potash both do fertilizers. Now, going forward, I find these two some of the most interesting right now just because the inputs that go into making fertilizer, like natural gas and stuff like that, are at like historical lows. So their inputs are a lot lower than they have been before, which should increase their margins overall. And these guys have been getting really beat up lately. So to me, these two ultimately are probably going to be the ones I really look at, you know, and that's why I looked at some of these oil stocks also, is because they have been pretty beaten up over the, you know, last several months because oil prices have been going down. So I am not bullish on oil in the near term, probably next 6 months or so, just because if you've watched any of my daily market commentaries, you know, you probably heard me rant about the Saudis and OPEC are not going to allow oil to go above probably $50, $60 for sure. They're not going to let it go above that because that's where it starts becoming more cost effective for us to get our oil out of the shale oil fields. It costs us a lot of money to frack, and right now we don't have a very good system to get that oil out of shale. I mean, we've obviously figured out a way to do it, and in that, now Saudi Arabia knows we have more oil than them. Ours doesn't bubble out of the ground. We don't have to just go and grab a bucket and scoop it up. So, which is what they can do. They separate the rock from the oil. We have to separate the oil from the rock, which separating oil from a rock is a lot more difficult than separating the rock from the oil. So they want to keep our prices suppressed. And in that, I think that oil is going to stay pretty low, and these guys are going to struggle a little bit. Anyway, that's my 2 cents. Take it for what it's worth. It may be worth nothing. So I'm looking at things that are going to have some high correlations. If you look at Lulu and Under Armour, just on the matrix, 70%. So that kind of correlates to what that other study I was showing you with the chart. One thing I've always said is Pepsi and Coke are not the same kind of company. Pepsi is 60+% of their revenues are generated in the snack aisle, like Frito-Lays and chips and different types of munchies, I guess. Whereas Coke is really a liquid company where they're producing different kinds of soft drinks and drinks like that. So there are different companies, but having said that, you can't pass up on the idea that they are very strongly correlated. So in that regard, they are a correlated company. I mean, you can have companies that aren't really in the same business even that have a higher correlation. Of course, I don't have any on this matrix, but I've seen it happen before when we were flipping through some of those other ones. You'll see them all of a sudden pop up, like how is Pepsi and ExxonMobil correlated? Well, I don't really know how that happens, but it's happening. So that is something to put on your radar. Mosaic and potash, that's not, I mean, we already went over that, but that's an outlier that would have to be kind of looked at. So if you didn't want to do it where it's always in the same sector, like potash and Mosaic and Chevron and ExxonMobil, something like that, well, this is another way to diversify that risk in a regard where you're going in different sectors of the economy and still being able to create this type of strategy around that. And if you wanted to put, say, some ExxonMobil in there and some Pepsi, then that might be something to look at. Okay, does that make sense to everybody? Is this little matrix? Probably. I mean, this to me was like a big deal when I found this website out. It was kind of like, oh, I can just punch these in there and I don't have to try and eyeball it and do a lot of research. It kind of dumbs it down for you. So that is a good website. And you can even do, I think you can even, I mean, you could do negative correlations. If they thought there was something that was a negative correlation, it'll give you, like the negative correlations and stuff like that. So you can play around with that for just many of your strategies and your hedging. So, and I have nothing to do with those guys. I just, believe it or not, I stumbled across that website and that matrix, and that's the only reason why I did it, is to throw a bone out to you guys, because I've been doing it this way for countless years, and that saves me probably 100 steps of just throwing darts at the board and trying to use my own brain, what I would think what should be correlated, and then find out, well, they really aren't that correlated at all. So like I said, going forward, we saw that Lulu and Under Armour are correlated, and I don't know if I had Nike on that one or not, but you can see they're correlated too. I mean, even though they're spreading out. The idea is the peaks and the valleys where they kind of line up. That's the real correlation. They may not, one will maybe outpace the other one, but the idea is the peaks and valleys on this type of chart where you're lining it up and seeing if the peaks and valleys are constantly lining up. Okay, one may be a leader and one more of a lagging indicator, but that's the idea of that. And as you can see, they're both on the upswing. So you could do this in that type of strategy or with those stocks. But having said that, with those stocks, then we have to go back and look at our implied volatilities, which I put it up on my watch list right here. It's IV%, and you can go into the that same type of customizing, and you just find it over here, and you can pull it over, which is what I've done. And I've also done a similar thing down here. You guys can all see this part of my screen, right? I got a bunch of questions. Yes, Kathy, negative correlations could balance a portfolio. Absolutely will. But for this, it's more of a, for me, I'm looking to add something to my portfolio. So that would, that's not really what this one is about. But that's what made me think of that is, yeah, you do want some negatively correlated underlyings in your portfolio because they don't always all go up. Especially when you see these funds, when they really move from one sector to another, that sector they're moving out of just pretty much gets decimated. And there's a lot of opportunity when they do that because they're getting oversold. So I've got a ton of examples going through my head, but I don't want to get into that right now. But and then you can pull this the same way on this watch list. I have it as the correlation where you can go into the customizing. You just go over here to the correlation study and pull it over. And, you know, you hit OK and it populates it. So these are correlated. I haven't figured out a way to find if they can correlate to something other than what their correlation is saying. Oh, I guess I could just do it like that. So I suppose I could correlate these to, let's just say UA. If I really wanted to add Under Armour, let's say, I don't know if that's gonna. So yeah, it will do that. So never tried that before, but so you can go through and see CMCC. I don't even know what that stock is really, off the top of my head. Seadrill, it's got a pretty high correlation too. Boeing, which is kind of strange. But that's crazy. So yeah, interesting. I learn something new every day too. So you can play around with that. So I use that to figure out what the correlation to the S&P is for the most part, because you know, if you're really highly correlated to the S&P, which most people are, just because they're long stocks and stuff like that, you might want to get some negative correlation in there. Where is that website for it? It is it's macroaccess.com, I think. Let's see. Why isn't my screen showing anymore? Am I showing this from? Sorry. Guess I'm not. I guess I lost that for some reason somehow. There it is. So that's the link for that investment market correlation, and you know, all it's done, that's the same link except it's populated in there what my thing is. So it's just market access / invest correlations or market correlations. And you know, when you get this in your email, you can always pause it and stuff like that. So anyway, so I always look over here. This is like the first thing I ever look at when I'm doing any kind of study. It doesn't matter what it is or strategy. I'm looking at these to figure out who has the high implied volatility. So Nike and Lulu, I think I have Nike. I do have Nike in my portfolio, but Lulu I don't. But the one thing that I don't have anything of is something like these, like a Mosaic or Potash. So that's the ones I really looked at. And as you can see, both of those have high implied volatilities. But something like Lulu and Nike, let's just see. Did I have Nike in here? So I could just go Lulu and Under Armour. So I could just go up here and knock out Under Armour, and hopefully I haven't gone over my daily limit. And you can build the correlation on it. So it should populate it in Nike, and we can just see what Nike and Lulu are. So it's a 0.6. It's not super significant. It is significant. It's positive, but I'd much rather have that like the Under Armour, where it was more like the 70s for that. That makes sense? All right. Tell Mark Micro Access that Pro Trader Strategy sent you there. Anyway, on the how did you hear about us? So tell them Wolfman sent you. Anyway, so you could do it with something like Nike or Lulu, and some of the other like Best Buy and Walmart and Target and stuff like that. Although you would be surprised, Walmart and Target I would think would have a high correlation, and they really don't have a high correlation to one another, or as high of a correlation as I would want. But you could look at like Google and Yahoo and stuff like that. Those are a little bit high flyers, and their prices are so far away. I don't want to really take a 200 shares of Google into my portfolio. That would really throw it out of whack. So I usually try and stay away from those big, huge ones for my account, but it depends on how much money you have in your account, I guess. So, all right, so let's move on to this potash trade. So now if you're normally used to doing, 500 shares of stock in your core portfolio, I would suggest doing maybe 2 lots in this, because then you're going to be doing 400 shares or something like that. If you're used to trading 5 lots in the options, I would definitely go down to 1 lots in this strategy and play it that way, so that you're not really putting a lot of risk in there. And because you're doing a 4-legged strategy with 2 different underlyings, that is going to tie up quite a bit of margin. So you got to think about that also. Make sure you have enough money in your accounts to cover if you are going to get assigned on these too. So that's the way I approach this strategy. Is, like I said, I'm looking to, my mindset going into this is, if it gets put to me, I'm more than happy to take it, because, for instance, with this strategy, let's go over to the trade, and it's got it on ES. So potash. So what I do is, like I said, I look for the 35-ish, and I put this in there today, but I go for like the 35 delta, which is right here. And 35 delta means that I have a 35% probability of it being in the money, which gives you about a 70-some% of it being out of the money at expiration. But I'm also looking at this like, it's trading down there. If I look at the charts, it's at historical lows. You can even go up here and look at it from the week. I mean, historical lows, they've been beating earnings. Oh, they didn't beat there. Oh, it was Mosaic that just recently beat. So they missed a little bit here and there. But Potash is a great company as far as I'm concerned. But what was I going to say with, let's look at natural gas. You can see this is one of the major inputs to making fertilizer, because it makes some kind of ammonia. They mix it with something else, and somebody else might know more about that. When I was in the grain room, I used to know all the things about that potash and Mosaic, but it's been quite some time. But anyway, of course, it's not going to come up for me. But nat gas is at historical lows also, so maybe it's because we're outside of. But you can look at it later. I don't want to waste everybody's time waiting for this to unload or to load. And with Mosaic, so Mosaic was a little bit different, and you know, neither one of these have the February options, but with Mosaic was the 30 something ish. You know, of course I would like it to come out here to the next strike away, but with these, I wasn't able to do that. So what I do is I'll look at this premium at the 30-ish delta here, and I'm collecting about $1 there. So then when I go out to the next cycle, I'm going to be pretty much picking that strike that is comparable in the premium I receive. Okay, so it's what is it? It's not brain science or rocket surgery. You know, it's picking the price that's as close to my premium that I collected before. Yes, you do have to consider assignment fees, but you know, your assignment fees are going to be pretty close to what you would have to pay if you paid for the stock. So, or if you were to buy the stock. VXX, selling puts in VXX. Yeah, you could. I mean, I like to stay away from VXX. It's just a personal thing of mine. So it's just, I don't play around with a lot of that. So I haven't really tried selling. I don't know what a success rate on that would be. Oh, you're in Canada? The assignment fee? Yeah, it's like $20 or something like that, $25 here also. But you know, if I were to go buy a stock, for the most part, it's going to be pretty close to that, or 100 shares of stock, it's going to be, I guess, half of that. But you know, it's a bit of a risk there. But that's all part of your, oh, $45, 40 or 43. Wow. That is terrible. You guys are getting robbed. So, but yeah, you do have to think about your assignment fees. That's true. I usually don't. As often as you're going to get assigned on these is it happens less often than you're going to get assigned. And I only do this strategy probably maybe 3 to 5 times the whole year, because you know the stars have really got to line up where you know you have a high implied volatility in Lulu and Nike, or let's say Lulu and Under Armour. You see, Under Armour is not even on this list. I don't know what Under Armour is. You know, it's at 33, so that would have pushed out the Lululemon Under Armour correlation for me, because Under Armour just doesn't have the high implied volatility. It's got to be over 50 for me to for both of them to implement this strategy. So, you know, and you couldn't even do that with Yahoo and Google for that matter. So, Chesapeake's just, it's below $5. Poor stock. Anyway, I mean, I think that was like 30 earlier this year. But anyway, so they got all kind of lined up, like Wynn and Las Vegas Sands. You know, Las Vegas Sands doesn't meet the criteria. It's outside of the 50. So, you know, really on my list here, you're kind of down to Mosaic and Potash, or let's say Nike and Lulu. And since Nike and Lulu doesn't really meet that rule of 70%, you know, so you can see where you start whittling this down, where if it's not meeting our checklist, don't do it. You know, don't push a trade. There's other trades out there, and move on with it. But this one was something that really looked good to me. I've been watching Mosaic and Potash for some time, and is it a bottom? I don't know. Am I picking a bottom? Yeah, kind of. But there's pretty good support that it's found here with Mosaic, and with Potash. It's you know, found about, it made a new low here. This is on a week, but you know, you can see that it's kind of trended sideways. So as they've been beaten up pretty bad, you know, they're at real lows. And I said this before, you know, farmers aren't going to stop using fertilizer, you guys. I mean, they are, yeah, Kathy, it's been bottoming at weeks for, keeps making new bottoms. It's, so is potash, but you know, it's trending sideways. So if we can, you know, get outside of that just a little bit and it's trending sideways, we're going to be able to, and it's trending down slowly, but you know, as long as we get a couple of these pops here and there, you know, we just want it to stay above where our short strikes are. So, you know, it could eventually go down below that 18 strike that I'm short in potash, but hope, you know, that's hopefully going to be after 45 days, you know. And if this really pops up, you know, I'm going to follow the same rules that I've talked about in many of my other webinars, is when you put this strategy on, you know, take it off when you've are about 50% of your max profit on, or what you've collected. So if I've collected 50 cents, if it gets down to a quarter, that's probably where I'm going to pull it off and peel it off, take my money and run. So if you get a pop in here and that, you know, in both of these or whatever, or even one of them, say, Mosaic starts really rallying and potash is just kind of going down. Well, if I've collected on the potash $1 for the strategy, you know, I collected 50 some cents there, and you know, another 50 cents here, or let's just say $1 total. So 55 cents, 45 cents, $1, which is, I think, right where I got that one, potash. And, you know, so potash doesn't really do anything. I'm not making any money here, but in all of a sudden in Mosaic, for some reason, it starts popping. And, you know, I've been able to collect about $2 here. You know, if my Mosaic goes down to, say, you know, $1.75, where I can buy it back for 75 cents, and potash is still sitting there at $1, that's probably where I'm going to look to cover that. Somewhere where I get a total premium back of about $1.50, because I'm going to be looking at this as a total one trade, even though they are two separate trades. So if I can get 50% of my $3, then that's probably where I'm going to look to do it, and get out of it. Does that make sense to everybody? When I'm doing these, I do one contract. Talk is asking how many contracts do I do. I do with one contract, but it has to do with what you're comfortable with doing also. If you are used to doing, you know, 25 lots or something like that, you might be doing this as 5 lots. If you are, and you know, I do between 5 and 10 lots on most of my strategies, but with this one, because I don't carry a huge core portfolio, so I don't have a ton of, you know, of stocks in there I think I have like 10 to 12 stocks in there at any given time, and usually it's at the low end of about 100 shares each. Okay, so I have to consider that, where if I get assigned on both of these, I'm going to probably have 200 shares of Mosaic and 200 shares of potash in there also. So that's going to skew my portfolio a little bit. Having said that, you know, I've lowered the cost basis on my core portfolio dramatically by selling calls against it once I get into these types of strategies. And then once you pop it up, you know, I let them either call it away from me or sell them out for a profit later on. Why did I say Nike was not a fit? The reason why I said Nike was not a fit with Lulu, because, you know, Nike is probably a better fit with Under Armour, or Lulu is a better fit, I should say, with Under Armour. But Under Armour isn't above 50% IV. And if you guys aren't familiar with the IV percent, this is implied volatility, and you can have a chart of it. The IV percent is a percentage of where it is now upon itself for the last year. So what the toss does, in a sense, is takes where this IV percent is now, 37, and on the, so you have a numerator and a denominator, right? On the numerator, which is the top, you take where it is now minus where the low is, and then you divide that by the difference between the high and the low. So then that's where it creates the IV percent over here. And so, Sophie, to answer your question, sorry, I said Nike was not a fit because if we looked back to our correlation study here, Lulu being this and Nike on this, it's a 0.6, so it's significant. And my rule of 70% or better, it could be fudged a little bit, I guess, if you thought that it really was going to be more significant. But 50-50 is, it's a coin toss, or it's a toss of a coin, right? Whether it's correlated or not, and 60 is pretty close to a coin toss. So that's why I said that Nike and Lulu would not fit for my parameters on this particular strategy, right? But yeah, so Mosaic has been trying to find a bottom here, and is it going to come down here and test this low here? Yeah, it might, and I probably will get tested on my strikes. The probabilities of me being tested are twice what the probabilities of it being out of the money, or your delta. So if it's I have about an 80% probability of being tested on this strike. So you can basically double what your delta is, and that's, the delta is the probability of you being in the money at expiration, and the probability of you being tested is double the delta. It's just quick and easy. It's not exact, believe me, it's not exact, but as a floor trader, that's the way we always looked at it, and it is pretty darn close. You can just, our thinking is, I'm going to get tested on this, double the delta. My probabilities of being out of the money at expiration is approximately 7%, 17% here, and 39% here. Does that make sense? So yeah, Sophie's asking, so I short both stocks in both months. So you're doing a total of 4 contracts, but I'm collecting $1 here. I'm going to try and collect $1 here then, because that's around the closest. If you can get 35 delta, which is, I think the optimal, or 32, something like that, then that's where I would go. But because I would like to get further away, obviously, but going to a 17 delta on this and only collecting 40 cents for it, to me was, it didn't look as appealing to me. And I was willing to take a little bit more risk for that. So why 2 months apart? Because I wasn't given the February on this particular one. Apple's going to give you a lot more options, option expiration months. But with this one, it didn't. So if I were to do something like, let's say Lulu, if I were to do something like in Lulu, then I would probably be, Lulu doesn't have it either. Some of the more popular ones will. So Jan, I don't even have April. Another one thing to look at is how close the bid ask is also on these. So this has pretty tight markets. That was something I usually mention in the other ones. Just make sure you have a pretty tight bid ask. You don't want this to be like $2.25 and then $3.40 in an underlying that nobody trades, because you're going to have to give up so much edge to get in and out. It just doesn't make it worth it. So this is the Analyze tab, just because I accidentally hit on it. and it's got the potash on there. So you can see my max profit on this is going to be right around the dollar, or is going to be the dollar that I collected if it expires worthless. But my break even is going to be right there at 1750. So that's something to look at if this is going to be something you put in your core portfolio. My break even when this goes below 1750 and then sells off. But like I said, at that point, I'm going to be taking this into my core portfolio and then start selling calls against that to lower my basis even further from 1750. Does that make sense to everybody? Yes, Sophie's asking about a bull put spread. You could, and I thought about doing that and going over that, but I thought that this was going to run a little long by doing this. But if you were going to do a bull put spread, yeah, absolutely, you could totally look at doing this as a bull put spread for sure. And I looked at doing this also as a bull put spread, and it didn't really fit my parameters on the potash, where I like to try and collect about a third the width of the strike, which like 33 cents for a dollar wide. And the reason why is that gives you about a 70% probability of success. So when I'm doing spreads, I looked at trying at least getting about a 70 probability of being successful on that. It's just the way the math works out. And I wasn't going to really be able to get 30 cents for this. It was going to be more like a quarter. So on something like that, then I'm generally more willing to take some more risk on it. But that's up to you guys on your risk parameters. If you don't want this to come into your account and you don't want to take this, or if you're trading in an IRA, you might have to have that defined risk on there. So this would be more for probably a margin account if you're doing the naked. But if you're doing this as a spread, the mosaic is probably going to give us the mosaic would be about 60 cents also, so 65. So for $2.70 or $2.50 wide, I'm going to be wanting to try and collect about what is that? It's 77 cents, I think, is what it comes out to be, but 70 plus cents is what I look for on a $2.50 wide one. Is that right? 66, 15, 78, yeah, it's 70, 80 cents, something like that. So usually 77 cents is what I'm kind of looking for on a $2.50 wide, which probably should be right around that 33 cents for a dollar wide, right? Something close. Does that make sense for everybody so far? So yeah, if you're doing that, that's the way I look at it. 33 cents for a dollar wide, and then just, for a $5 wide, that would be, $1.55-ish plus. Because you're multiplying $5 times 33 cents, right? I try and, when we were on the floor, these were all things that you had to do this math in your head so fast. These are like little things that we used to do, everybody used to know, and it was so that you could, when you're getting a quote, somebody says, what's the quote? First guy to get the quote out there is usually the guy who got the order, kind of thing. So you got to come up with like real quick math things, and you don't want to be busting out a calculator and trying to time it because everybody else is screaming, and then the broker or whoever was filling the order just thought you were jumping on somebody else's market. But if you were the first one to pop it out there, then you got a little bit more creed for that. Which, at the end of the day, I just carry it over to this because it also correlates to different types of probabilities. That's really where the math comes out, is the probabilities. Like you could probably switch this up. So we got that as the 39 delta. What's the probability of being out of the money? Should be almost inverse of that, or probability of being out of the money at the time is right around that. So, probability of being out of the money. Why is that? This one's closer. So usually delta is going to be, so the implied volatility, oh wait, delta's over here. So the delta is, so it's close. So, 20, 39, so it's 40, so it's close to 60. So you can see, I mean, of course it's not exactly right. It's off by a couple, but, I look at it, it's a rounding kind of thing. The 7 is close to a 10 anyway. The 3 is close to the 5. We're off by a couple percentage points, but, you're really splitting hairs at that point. Does that make sense for everybody? That's the way I look at it. That's the way I was taught. So it's usually pretty on plus or minus a couple percentage points. Okay, so that's it in a nutshell. And what we're hoping for this to happen is that these start going back up. And potash or mosaic is something that I would be comfortable having in my portfolio. If it's something that you aren't, then definitely, like what Sophia was talking about, is create that defined risk strategy and or go out a little bit further and increase your probabilities of being out of the money at expiration. So, this is to each its own. Now, to go out here and only collect 10 cents or 13 cents, 15 cents, to me, the risk of that isn't worth the premium. I mean, if it goes through my 25 strike, and I'm only, then that's also where, some of my premiums aren't going to cover some of my cost of being assigned and all of that stuff. So I usually kind of wait for it to come down to an extreme level and then get pretty aggressive with it. If you're not comfortable with getting aggressive with it or don't want this to go into your account, then definitely go a little bit further out. Or not even do this trade and wait till you get like, something closer to a 30 delta. You're going to collect a little bit less premium on that, but, that's definitely something to look at, like if it came down to the 25, 26 delta and kind of adjust those rules that I have for myself to meet your guys' risk parameters and, your comfort level. All right, guys. Does anybody have any last minute questions? How about Sophie's asking about the calendar spread? Yeah, you can do it. Excuse me. Do it as a calendar spread for sure, rather than just laddering it. Anybody else have any questions out there? And keep in mind, we did mention this is going to be a big margin kind of thing. So, but you're going to be able to see this premium come out pretty quickly, and it's not something that I'm going to always hold on to forever. If it starts going against me, that's where I'm going to hold on to it a little bit longer. But like I said, if I see a quick pop in this and I can get out for, if it happened, say on Tuesday or something like that, and I got probably 20 to 30% of my max profit within 2 days, I'm most likely going to take that trade off. The faster I start seeing my premiums come out, the quicker I'm usually to pull the trigger and get out of it, because I know my probabilities of getting touched, even if it pulls away, are still those same probabilities. So, at the end of the day, it could run up and come back down. And I would rather take that 20% of what my max profit was, watch it come back down, and I'll put that trade back on again. I mean, I'll keep playing it that way, and it kind of ends up being like a scalp, if you will, but you can't, kick a gift horse in the mouth. If this strategy on Tuesday gave me 20%, I'm probably going to take that, you guys. And as soon as I get to 50%, that's where I'm probably going to take this, or I can almost guarantee you I'm going to take it. But, you know, if it starts going against me, that's something that I'm comfortable with. That makes sense. Dee Dee's asking how many underlyings do I have trades on at any given point in time? Different underlyings, I could say anywhere. You know, I just took off in the past 2 days. I just took off like 10 and added 4, but that was off of the sell off. And then the comeback today, I was taking off a lot of my shorts. So, you know, I still have at least 10 underlyings in my portfolio, and probably, I think it's like 9 core portfolio stocks. When to take profits. Today I put on a 75-70 put credit spread on Ultra. Took it off an hour later for a small gain of about 38 cents. How much did you sell it for, I guess? But if I, you know what? And then you go on to say, but if I would have waited later on in the day, it would have doubled that. You know what? I a lot of times don't even, once I pull it off, if you sold it, then D sold it for $1.28 and you bought it back for 38 cents in a day, done. I probably would have covered it faster than that. So I would say you did well, because you know, I'm looking at it like, don't look back. Oh, you bought it back for 90 cents. Yeah. In a day, sold it for $1.28 and bought it back for 90 cents. Okay. Yeah, then I would have definitely done that. You don't kick a gift horse in the mouth. If you start seeing those premiums happen really quickly, take it off and move on. You know, that's the way I look at it, you guys. And it may seem strange to some people because they like to write out options till they expire worthless. Well, I like to hit singles and doubles, and that's why I sell premium and I take my profits when they're given to me, and I don't buy premium, or I don't pay out for debit spreads a lot. Very rarely do I. I have been doing a little bit more lately because, as you can see, everything has low implied volatility percent. And that's the only time I will pay money for a option, is when they have really low implied volatility, because the thought process is implied volatility can only go up, and if it does, then I can be directionally wrong and still make money. Because when implied volatility expands, then premiums inflate. So you could, you know, I did this on the earnings trades where, you know, I could be directionally wrong on an earnings trade and be in the money after the event and still have made a profit because all of that volatility came out of those premiums. So that's the way I look at these. And DD, you know, in a day you make 28 cents on a trade, then I'm looking at getting out of that. So, well, you know, and you're saying you would have made a lot more money with a long call. Yeah, in hindsight's 2020. You know, if my aunt had a mustache, she'd be my uncle. So don't ever second guess yourself. You made the decision, you've done the work. You know, trust your gut and go with it. You know, I've known a lot of people that only bought option strategies, and you know, some of those guys made millions of dollars, and some of those guys went broke doing it. So you know, you got to weigh the pros and cons. You know, I've done well with selling options consistently over a long period of time, and it's because, you know, you stick to the strategy and play the probabilities, and that's what it's about. You know, what I like to have the probabilities in my favor. And one thing I have a tendency to talk about in other webinars, excuse me, is when you are selling premiums, you are kind of like the house or the casino. And when you are buying premium strategies, you're the guy sitting at the blackjack table, or you're the guy sitting at the roulette wheel. You are the one that has the odds out of your favor. Yes, you have the opportunity to win a boatload of money, but in the flip side of the coin, so does the house, because they don't care if a couple of guys win here and there. They know eventually the probabilities are going to work in their favor, and they're going to be able to buy another multi-billion-dollar casino. So, and that's why when you win big in Vegas, all of a sudden there's somebody tapping you on the shoulder and handing you a free hotel or to stay in their place. You know, hey, we're going to upgrade you for the night. You want to stay one more night? Whatever. We'll fly you back if you want, because they know they're going to win their money back if you stay there an extra 24 hours or so. Believe me, they know how long it takes to win back their money. They have those probabilities figured out. So it's the same idea with this. I play the probabilities of success, and you know, even if I go through a streak where I'm not making money, follow it, and it will eventually, the probabilities will work out in your favor. Okay. Yet you say found that selling premium leads to higher win rate but lower profitability. Well, if you're profitable, I mean, as long as you're profitable, and then you're saying win less but be more profitable. Well, if you're keeping track of it over time, I would have to say that you are going to end up losing money because the probabilities are not in your favor. But you know, if you're swinging for home runs, sometimes you get them, but you know, the guys that are swinging for home runs usually strike out more often than they get a hit. So anyway, that's about all I got for you guys today. I appreciate everybody's input as always. And you know, if you guys have any questions, you can go to protraderstrategies.com, and you know, like I said, we're going to be drilling down on other options components and how to trade different types of options. We're even going to talk about, with this whole movement of getting rid of stops, how you can use the options in place of those stops and find trades when and where. On the daily market commentaries, I'm always talking about what trades I found and where I think that they're appropriate. And here's a link to that. It's protraderstrategies.com, and if you check in your link box for the chat box, there should be a link in there for you guys to all hook up with that. And you know, if you've signed up for the course and you have questions for me, I am more than willing to, you know, go back and forth with you on your question or your problem. If you got an issue with one of your trades that's going against you, how to manage that, or what I see when and where, what I think about the trade. And I will work with you guys on that, because I do want you guys to learn all of this and make sure that you guys are crystal clear as to what you guys are doing. So you can contact us at 310-598-6677 or trading at protraderstrategies.com. Sorry, guys, I just got a tickle in the back of my throat after all of this. So, you know, I appreciate all your guys' feedback. I love the questions. It makes this go a lot faster and a lot easier. So please stay with us and do that. All right, that's all I got for you today. If you can't take that, take it easy.